All right, if you're serious about a career in finance, you absolutely have to understand how the big money moves. So this is your essential briefing on what's called Portfolio Management Services, or PMS. We're going to break down exactly what it is, how it really works, and why it's such a game changer in the world of high-stakes investing.
So let's just imagine for a second. 50 lakh rupees. It just hits your bank account. I mean, that's an amazing problem to have, right? But it's still a problem. What do? This is the exact situation high net worth individuals face, and it's the perfect way for us to start talking about a really sophisticated solution like PMS.
So here's our game plan. We'll kick things off with the absolute basics. What even is PMS? Then we'll get into the different levels of control you can have. After that, we'll decode the fee structures, which can get a little tricky. We'll even look at some new competition on the block, and then wrap it all up with a final briefing to make sure you're totally interview ready.
Okay, let's dive right in. What is PMS really? Let's get to the heart of it and see why people call it the gateway to truly personalized or bespoke investing.
You know, the best analogy is probably this. A mutual fund is kind of like buying a suit off the rack. It's made for the masses, it fits okay. But PMS, that's like going to a master tailor for a completely bespoke suit, crafted to fit you and only you. And here's the most important part. With PMS, you actually own all the individual stocks and bonds directly. They sit in your own personal DMAT account. It is your portfolio, not a share of a bigger fund.
But as you can imagine, getting this level of personalized white-glove service, well, it has a pretty high price of admission. The regulator here in India, SEBI, has set the minimum investment at a cool 50 lakh rupees. So why so high?
Now, you might think that number is just there to be exclusive, right? To keep people out. But it's actually not about that. SEBI sees it as a kind of risk filter. It's their way of making sure that the only people playing in this high-stakes arena are investors who have the financial capacity to really understand and, more importantly, withstand the sophisticated and sometimes risky strategies involved.
Okay, so let's say you've got the 50 lakh. You're in the door. Now you face your next huge decision, control. Just how hands-on do you want to be with the day-to-day running of your portfolio? And this is really the fundamental question, isn't it? Do you want to be the kind of person who tells your chauffeur the destination and then just sits back and relaxes? Or are you more of a co-pilot, where they suggest the turns, but you have to approve every single one? Your answer here is going to shape your entire experience with PMS.
This table breaks it all down beautifully. You've got three main flavors. First, there's discretionary PMS. This is the most common one. It's where you hand over the keys completely. The manager makes all the calls, which means they can act super fast. Then there's non-discretionary. Here, the manager suggests a trade, but you and only you have the final say. And finally, advisory, where they just give advice, you have to do all the buying and selling yourself. The real choice here is a trade-off. What do you value more, speed or control?
And this right here is the critical danger of holding on too tightly to that control. In a non-discretionary setup, imagine your manager spots a perfect, time-sensitive opportunity. They call you, but you're in a meeting, you miss the call. By the time you get back to them, the market has moved, and that golden opportunity, it's just gone. This execution lag can completely undermine the whole point of hiring a professional in the first place.
All right, let's talk about the really crucial part, the money. How do you actually pay for this premium service? Now, the fee structures can look a little complex at first, but they're all designed to do one thing: align the manager's success with your success.
Generally, you get to choose from three models. You've got a simple fixed fee, usually 1 or 2% of the total money you've invested. It's predictable, sure, but you pay it even if you lose money. Then there's the performance-linked fee. This is interesting. The manager only gets paid a slice of the profits they make for you. Great for motivation. Or you can do a hybrid model, which is a mix of both, a smaller fixed fee plus a bonus for good performance.
Now, when we talk about performance fees, there are two really important safeguards for you, the investor. The first is something called the hurdle rate. Think of it like a high jump bar in track and field. If the hurdle rate is set at, say, 8%, your portfolio has to grow and clear that 8% bar before your manager can even think about taking a performance fee. You only pay for true outperformance.
The second safeguard is even more important. It's called the high watermark. This is simply the highest value your portfolio has ever reached. So if your portfolio value drops, the manager earns absolutely no performance fee until they first recovered all your losses and then pushed past that previous peak.
It's a fantastic rule because it means you never ever pay for the same profit twice. Let's just walk through a quick example to see how it works. In year 1, the portfolio does great. It grows, a fee is paid on the profit, and a new high watermark is set at that peak. But in year 2, the market dips and the portfolio loses value. Notice what happens. No fee is paid, none, and the high watermark from year 1 stays put. Then in year 3, the manager not only makes back the loss but pushes the value past the old peak. The performance fee is only charged on that new profit above the original high watermark. See how powerful that is?
But, and this is a big but that you need to know for your interviews, there is a hitting downside to performance fees. In a massive bull market, a 20% performance fee can pull a huge chunk of cash right out of your portfolio. And it does this at the exact moment that capital has the most potential to grow. Over the long run, this can really put a dent in the power of compounding. It's a subtle but critical point.
Of course, the world of investing never stands still. Just when you think you've got PMS all figured out, a new player enters the scene and starts to shake things up. Let's talk about Specialized Investment Funds, or SIFs.
So what's the big difference here? Well, as we've seen, PMS is that high-end, bespoke, tailored service where you have to handle all your own taxes. SIFs, on the other hand, are more like mutual funds on steroids. They're pooled funds, they have a standardized strategy, and the taxation is way simpler. But the biggest, most disruptive difference, it's accessibility.
Remember that big 50 lakh rupee wall you have to climb to get into the world of PMS?
Well, SIFs completely demolish that wall. They lower the barrier to entry to just 10 lakh rupees. That's a fifth of the cost. This is a massive shift, and it's making these sophisticated expert-led strategies available to a much wider group of investors.
Okay, let's bring it all home. It's time for your final briefing. This is everything you need to know, boiled down into the key insights that will make you sound sharp in your next big interview.
If you walk away with nothing else, remember these 3 things. First, PMS is all about bespoke investing. It offers a level of deep customization you just can't get from a mutual fund. Second, that choice between discretionary and non-discretionary, it's always a trade-off between execution speed and personal control. And third, performance fees sound great for aligning incentives, but don't forget that a simple fixed fee might actually lead to better long-term growth because of compounding.
And to make absolutely sure you're ready to shine, here are 3 questions you should have a killer answer for. Number 1, how exactly does the high water mark principle protect clients? Number 2, can you explain the main operational risk in non-discretionary PMS? And number 3, what is the single biggest competitive threat facing the PMS industry today? Nail these, and you're golden.
So all of this leaves us with a really fundamental, thought-provoking question for the modern investor. In today's incredibly fast-paced markets, what's really more valuable? Having ultimate, hands-on control, or achieving maximum lightning-fast efficiency? It's the central puzzle of modern portfolio management, and it's something you'll definitely be thinking about as you move forward in your career.